As many of you probably know, Beyond Meat has seen a lot of price action as of late. The stock has jumped almost 50% at one point. Now it's actually down 10% out of that, but still it's up 40%. That's quite a lot. Does that mean that the stock right now is expensive, especially when comparing it with another food company out there, a food giant like Tyson Foods? Well, that's what we're going to talk about here today on the PlantStock channel. If you're new to this channel, welcome. If you're not, then welcome back. And if you're up for it and you want to help the channel grow a little more, I would appreciate an early thumbs up since it does help spread the videos to more people. And if you haven't subscribed to the channel yet, and if you're interested in Beyond Meat, Tattoo Chef, or the Very Good Food Company, to name a few, make sure to subscribe and don't forget that bell button. Thank you, folks. I truly appreciate your help. So let's take a look at the ticker symbol BYND. We know that just a couple of days ago, it had flown up to about $150, 152 at one point, which was from $100. It took about 10 days. So it went really quickly, 50%, over 50%. Then it's been trading down a little. We know it's about 20 to 30% shorts on this stock, right? And it went down to about 135 yesterday, at one point 132, but now it is up about 2.5%. So trading steady at the moment. So when it comes to the questions, is Beyond Meat expensive? Well, it all depends what we're comparing with. But if we're comparing it with one of the biggest animal agriculture businesses out there, Tyson Foods, then is it expensive? Well, let's take a look at the Motley Fool article here. Well, when it comes to comparing these two companies, obviously you should be careful as it states here. But on paper, yes, Tyson Foods does look cheaper. Now, it is really hard to use typical valuation metrics. We talked about this. Tyson Food isn't really a growth company. It's not a disruptive company at all, whilst Beyond Meat is definitely a disruptive growth company. But when you compare them then and not using value metrics like PE level, then you might want to look at price to sales. But to some extent, that doesn't make a lot of sense either, since again, Tyson Foods is not a growth company. But if you did use that, yeah, it would be about 0.7. And Beyond Meat right now is actually around 20, 22. Which is a valuation that's more than 30 times higher. So looking at it from that perspective, as they talk about here, Tyson's market cap is only about 3 times as much as Beyond Meat, but they do actually sell for about 100 times more. So looking at it that way, it does kind of seem silly as they state here. But you have to look at it at other points of view as well. If we first of all look at Tyson Foods stock, it's trading around $80 at the moment. And if we take a look at 5 years back, well, exactly 5 years, it was actually, or about 5 years ago, it was trading around 75. So that's a $4 difference. It's been going down, it's up and downs, and also during Rona, of course, it was hit pretty hard, but only went down to around 57. And then it's been going up again more and more as of late to the same thing that it was basically at 5 years ago. And why it's going better again is obviously restaurants opening up now with Rona chilling down and people taking their vaccines. And it's going to be the same story with Beyond Meat. But I think it's quite obvious that with this stock, you're not going to 2x your money. You're not going to 5x your money in any way. It doesn't make sense at all because it's not a disruptive company. As you looked at the PS ratio, basically what they sell is what the company is worth in simple terms, right? It's worth about $29 billion. So about $30 billion, right? It does have a pretty okay dividends if that's what you care about. So if you want to invest for dividends, I guess that would be okay. But I would say there's plenty of better companies than that trades actually at a higher dividends and actually has somewhat of a future. I'm biased, I know. So obviously, if a company like Beyond Meat has a much higher PS ratio, it has to have that for a reason, right? And as they state here in the article, it's because you're hoping for some kind of really fast growth rate and high profit margins. And if you take a look at it then, right, it's a little bit different, especially when you come into the margins here. Obviously, both these companies are protein companies to some extent. And if you compare their revenue, right, on the subject of margins, consider that in 2020, Tyson had over 43 billion in sales, but only about 5.4 billion in gross profit, which is about 12.5%. And this has been an ongoing thing the last couple of years, right? It's basically standing still, but it's getting a nice amount of money every year. But the gross margin, 12.5%. But if you compare it with Beyond Meat's gross margin, it's been 30% in 2020. And that's even during Rona, right? So 2.5 times better than Tyson's. But because they were hit harder than Tyson's, their margins were negatively impacted by the virus. As it states here, Beyond Meat had products packaged for food service partners that had to be repackaged and redirected toward retail channels once restaurant dining rooms started closing around the world, pressuring the company's profitability. So we know that. So again, coming back to the PS ratio, it is warranted that the PS ratio for Beyond Meat is a lot higher than Tyson's. Again, it is a company that's going to show exponential growth in the coming years. But obviously, we need to see a lot of money coming in as the years go by. But there are some things that we have to look forward to, as they mentioned in the article too, but we talked about it often here. And it is that one of the most intriguing aspects right now with Beyond Meat's growth is that they're focusing on an international expansion, and China being one of the new ones. We know that they have a plant in China now that's fully operational. They're building one more. And as it states here, remember, China is one of the largest populations on the planet, or it is the largest population. But it is also one of those countries that eats the most meat on the planet. And one of the interesting things they also talk about in this article is that they actually consume double the amount of pork what the people here in the EU does. Double the amount. And we still have a lot of people in Europe to begin with, about 750 million, right? So that's a lot of meat they eat there. And they are having a lot of problems now when it comes to pork supplies because there's an ongoing swine fever breakout. And it's not the first time. We know there'll always be some kind of fever, some kind of pandemics, as long as we keep using animal agriculture the way we do. It's bound to happen. So having a facility in mainland China that actually supplies the population with a pork equivalent, a Beyond Pork, so to say, this could actually really spur that growth in the company. And we've talked about this before too. If you haven't seen my video on Beyond Meat and China, take a look at it here. It's kind of old, but I think it holds up. Let me know, folks, what you think about it. But it kind of talks about that the younger population in China, just like here in the West, right? They care more about their health. They care more about sustainability. So they do understand that eating too much meat to begin with, or dairy products, is going to be bad for your health and bad for the sustainability. So they are looking into these kind of products. And another thing why it could actually be worth to buy Beyond Meat stock at this current price is that also something we talked about is the plant-based chicken products that is going to be available soon. I think it should be during this summer, and that is obviously going to be really huge because of what we talked about many times. In the US and many other countries, people actually consume a lot more chicken than red meat. So having a plant-based alternative that's going to taste well, and I do believe if anyone can do a product, can make a chicken alternative product that tastes well, that's going to be Beyond Meat, considering the amount of money and research they put down on this. So that could also long-term make the company really fly up there. And then something that could be the most important thing of it all is price parity. As Ethan Brown, the CEO, has stated on many occasions, by 2024, they want to have developed a product, one of their meat products, I'm thinking maybe the burger, that's actually going to be not only the same price as a typical meat product, but actually cheaper. And we know, obviously, that's going to be a game changer. But in close connection with this, as they state here, Quote, however, it will lower prices in conjunction with gaining operating leverage. It won't sacrifice its healthy margin. When plant-based meat is actually cheaper than the real thing, mass consumer adoption is more likely to ensue. So in conclusion, should you invest now or should you try to wait for a better price? Well, it all depends, right? First of all, we don't know if you're going to get a better price. We can't time the market. But if you are playing the long game, as I am on this channel, then definitely this is the right price, right? Because we've been talking about the PE's ratio now, right? The PE's ratio is about 22, and they were talking about revenue numbers. And again, we know what that means, right? Because right now, Beyond Meat for 2020 had about 400 million in revenue. But as we talked about in this video up here, take a look and looking at the stock prediction, we're talking about a company that's probably going to be making about $5 to $10 billion in revenue in the next couple of years. In, I would say, 7 to 10 years, right? And that means that if they come up to 10 billion in revenue, well, that price to sales revenue is going to be totally different because they're normally now around 9 to 10 billion in valuation. So if you come up to 10 billion in revenue in the next 9 to 10 years, that would actually mean that they are at a PE's ratio of around 1. Basically the same as Tyson Foods. But obviously this is a growth company, so at the very least, in 9 to 10 years from now, I expect a PE's ratio of at the very least 10, which would make it a lot more expensive as a stock, around $1,400 to $1,500 per stock. But I do believe there's other possibilities that it could actually be higher. Again, take a look at the video. And if it is that you're planning to only have this company maybe a half a year to a year, so just use a very small amount of your money. And if it is that it dips more, as I've always preached on this channel, do not sell out. This company is not going to go bankrupt. So just wait it out then and maybe dollar cost average. So folks, I'm truly interested to hear your opinions on this. When you compare Beyond Meat to Tyson Foods, where do you see this going in the long run? Who do you think will be there in 10 to 20 years from now? I'm really interested to hear. Well, folks, that was it for today. I truly hope you got some value from today's video. And if you did, make sure to smash that like button and help me out. And if you want to keep getting more information regarding Beyond Meat, Oatly, Very, or TTCF, to name a few, make sure to subscribe. And please do not forget that bell button. Thank you, folks. And as I think you know by now, this was not financial advice. These were just my own thoughts and opinions. It's important to do your own due diligence and invest safe. Have a wonderful Wednesday. Hope to see you soon, and peace out.